Hey everyone, and welcome. Today we're going to tackle a topic that, let's be honest, affects every Hey everyone, and welcome. Today we're going to tackle a topic that, let's be honest, affects every single one of us every single day. Inflation. You hear that word constantly, right? But what does it really mean, and where does it even come from? All right, let's get right into it. I mean, this is the question, isn't it? It's on everybody's mind. You've definitely felt it. That little pang at the grocery store, at the gas pump, that feeling that your paycheck just doesn't go as far as it did a year ago. Well, in this explainer, we are going to break down exactly why that's happening. So, to really get a handle on this whole thing, we've got to start with the absolute basics. What in the world is inflation? Well, at its core, it's really all about the power or the shrinking power of your money. Put simply, inflation just means that your dollar today buys less stuff than it did yesterday. The price of pretty much everything, from your morning coffee to your car, slowly creeps up. And as prices go up, the value, the actual purchasing power of your hard-earned money goes down. So how do we even know how bad it is? Well, economists have this tool called the Consumer Price Index. You've probably heard it called the CPI. And the best way to think about it is like a giant national shopping list. Every month, they put the same stuff in the basket. Milk, bread, gas, rent, and they check the total price at the register. And by seeing how much that total bill goes up over time, they get a really clear picture of how fast prices are rising. Okay, so that's the what. We know inflation is when prices go up. But the billion-dollar question, of course, is why? Why does this happen? Well, it turns out it's not just one thing. Economists usually point to three main drivers. And here are the big three. You've got demand pull, you've got cost push, and then there's this really fascinating psychological one, inflation expectations. Let's break each of these down. First up is demand pull. Now, this is the classic textbook case of too much money chasing too few goods. Just imagine for a second that everybody, you, me, businesses, the government, is out there trying to buy stuff all at the same time. When there's way more demand for things than the economy can actually produce, well, prices get pulled upwards. It's just simple supply and demand. The second cause is what we call cost push inflation. This happens when it just gets more expensive to make stuff and provide services. A perfect example is a spike in oil prices. Suddenly, it costs more to transport everything, from car parts to vegetables. And guess what? Those extra costs don't just disappear. They get passed along to you, the consumer. The prices are literally getting pushed up from the supply side of things. And this brings us to our third cause, which honestly is maybe the most interesting because it's all in our heads. It is the power of our collective expectations. If we all start believing that prices are going to keep rising, we change how we act. You might ask for a bigger raise at work. Businesses might raise their prices just because they expect their own costs to go up. It can become a self-fulfilling prophecy. And this is exactly why the people who run central banks are completely obsessed with what they call anchoring inflation expectations. Because whether we, the public, believe inflation is temporary or here to stay is absolutely crucial for keeping it under control. And you can see right here the two different paths this can take. With anchored expectations, we all basically see a price spike as a temporary thing, a blip on the radar. We don't freak out, our behavior doesn't really change, and inflation eventually settles back down. But with unanchored expectations, it's a totally different story. Everybody thinks high inflation is the new normal. So what happens? We demand higher wages, businesses jack up prices, and that expectation becomes reality. Inflation can really start to spiral. It just goes to show you, in economics, what we believe can literally shape our reality. So if inflation is starting to run hot and those expectations are getting unanchored, who are the firefighters that come in to cool things down? Well, this is where central banks step onto the stage. Institutions like the US Federal Reserve or the European Central Bank have a primary mission, keeping prices stable. Their main job is to keep inflation low and predictable. Most of them are aiming for a sweet spot of around 2% per year. And how do they do this? What's their big weapon in this fight? Well, it really comes down to one incredibly powerful tool: interest rates. So when inflation is too high, the central bank makes its move. It raises interest rates, and that one action sets off a whole chain reaction across the entire economy. Instantly, it becomes more expensive to borrow money. That loan for a new car, that mortgage for a house, that capital for a business to expand, it all just got pricier. And when borrowing costs more, what do? We tend to pull back. Households and companies think twice about taking on new debt, so they spend less and they invest less. And what does less spending lead to? Well, that overall demand in the economy starts to cool off. It eases that demand pull pressure we talked about earlier, and eventually, that's what brings inflation back down. But, and this is a really big but, using interest rates to fight inflation isn't some magic wand. It is an incredibly delicate balancing act, a high wire dance with some really serious risks. There's this quote from a Federal Reserve paper that just nails it. The two goals, cooling off inflation and keeping the economy strong, can be in direct conflict. Because the very tool you use to slow down price growth also, by definition, slows down the economy. If the central bank raises those rates too high or too fast, they risk slamming the brakes way too hard. And that can tip the whole economy into a recession. That means businesses shrink and people lose their jobs. It's like trying to land a jumbo jet on an aircraft carrier. You have to get it just right. And the absolute worst case scenario, the economic nightmare that policymakers have nightmares about, is something called stagflation. It's a toxic, painful combination of a stagnant, no-growth economy, high unemployment, and stubbornly high inflation all at the same time. It's the economic equivalent of being stuck between a rock and a hard place, and it's incredibly difficult to fix. Okay, so we have covered a lot of big, abstract economic ideas here. Central banks, interest rates, stagflation. But what does all of this actually mean for you, for your wallet, for your life? Let's bring this all back home. Look, when you hear the news that the Fed raised interest rates, it's not just a headline. That decision directly impacts your mortgage payment. It changes how much interest you can earn in a savings account. It can make the stock market go haywire. And maybe most importantly, their whole battle against inflation could determine whether the economy tips into a recession and what that means for your job security. So that leaves us with the massive challenge facing pretty much every economy around the world right now. It really is a delicate dance. And the one question on everyone's mind is, can the people in charge tame inflation and bring prices back to normal without pushing the entire economy over a cliff?